The stock market falling, crashing can be a scary thing when you're not informed on how to make money during a stock market crash. This year has been an absolute roller coaster for markets. The market has made some progress, but some industries take longer to recover. Here are the 10 stocks down 70% plus. Number 10. Occidental Petroleum Corp, OXY. Oil and natural gas producer Occidental Petroleum, which hails from the worst performing sector in the market. In a year when oil prices briefly turned negative, it's no surprise that OXY has dramatically underperformed. The company has lost money in the last 4 consecutive quarters and had to take a monstrous $6.6 billion write-down charge last quarter due to the cratering value of its oil and gas assets. Number 9. Mosaic. It's been a rough road for Mosaic. MOS $14.30. The shares are down up to nearly 70% plus over the past 11 years. As recently as 2011, MOS traded hands at nearly $90 per share. Today, it doesn't even fetch $15. Mosaic produces and markets fertilizers and other farm products based primarily on phosphates and potash. This was a fantastic business to be in during much of the 2000s. After years of neglect, investors flocked to basic industries and commodity companies. Mosaic share prices soared by a factor of 10, rising from less than $15 per share in mid-2006 to over $150 per share at its 2008 top. Alas, it wouldn't last. Falling commodity prices have led farmers to spend less money on fertilizers, which has in turn led to a supply glut. This has effectively squashed any hopes Mosaic had of growth. Revenues today are lower than they were in 2008. The coronavirus scare might give Mosaic a short-term reprise, as phosphate production in China is expected to decline due to a work disruption. Number 8. Sabre Corp, SABR. Sabre Corp operates in precisely the area of the economy you wouldn't want exposed to in the last year. Although technically a tech stock, Sabre's niche targeting of customers is what has done it in. SABR provides tech solutions to the travel, airline, and hospitality industries. This doomed triumvirate is reflected in SABR's most recent quarterly report, with revenue tumbling by 93%, clocking in at $83 million compared to $1 billion the year before. The net loss last quarter was $444 million against that $83 million in revenue, a crazy decline from the net income of $28 million a year before. After making $1.01 per share in 2019, analysts don't expect SABR to turn a profit again until 2022, when they foresee earnings per share at 18 cents. Number 7. Transocean. Onshore shale producers are hurting these days, but the beauty of the shale plays is that they are relatively easy to switch on or off as demand warrants. It's not that expensive to drill a new well, and production declines quickly. So long as you're well capitalized, a good shale producer can survive in this market. Transocean specializes in ultra-deep water drilling. The problem is that there is very little demand for those services in a world in which there is an oil supply glut, and fresh supplies can be easily produced onshore at a fraction of the price. Since 2013, the company's annual revenues have dropped by 2/3. Transocean shares have been in free fall, losing more than 95% of their value over the past 11 years. For RIG to mount a recovery, energy prices simply must show signs of life. Number 6. Carnival Corp, CCL. It's no secret that the cruise business has suffered a horrific 2020, as cruises turned out to be the perfect incubator and spreader of the virus across the world. Analysts expect a 71% decline in revenues this year from Carnival, and even if their projections for a 70% rebound in 2021 revenue comes true, Carnival's 2021 sales will still only be about half of what they were in 2019. With the customer discounts and costly safety precautions needed to reinvigorate demand going forward, it's unlikely margins or even the hint of profits will come back to CCL in the foreseeable future. It's entirely rational that shares have declined so precipitously this year to reflect that. Number 5. Marathon Oil. It's not at all surprising to see another energy E&P company make the list. Another laggard from the energy sector, Marathon Oil, is a Houston exploration and production company that was, in some ways, an inevitable casualty of 2020's epic energy bear market. MRO $6.83 is down 70% over the past 11 years. The stock price topped $41 per share in late 2014. Today, it's struggling to hold at $7. The company boomed in the 1970s commodities bull market and lived through the brutal bust of the 1980s and 90s. And despite the carnage in the industry, the company still is profitable. Brokerage firm Jefferies reported it was giving up on energy, as the oversupply situation doesn't look to be resolving itself in the near future. Number 4. EQT Corp. Up next is EQT Corp, $6.39. The stock has lost nearly 78% of its value since the 2009 market bottom. Headquartered in Pittsburgh, the company produces natural gas liquids, and crude oil, and it has the distinction of being the largest producer of natural gas in America. Alas, that meant a lot more when natural gas prices weren't stuck near all-time lows. But until prices rebound, it's hard to see EQT shares enjoying a sustained rally. However, it is worth noting that the stock is cheap, trading at roughly 0.2 times book value, 0.6 times book value, and 18 times forward earning estimates. Number 3. Range Resources. Life hasn't been much fun for long-suffering Range Resources, RRC $2.62 shareholders. The shares are down 93% over the past 11 years. The stock was essentially a highly leveraged bet on energy prices. In April 2000, RRC traded for less than $1. By its peak in 2014, the stock traded for north of $90 per share. It frequently made best stocks list, and anyone who had the good fortune of buying near the low made close to 100 times their money. Unfortunately, it didn't last. The stock has given nearly all of those gains back. Range Resources has a long history, and the company might manage to pull a rabbit out of a hat and turn things around, but that will be exceedingly difficult without a major improvement in energy prices. Number 2. Technipfmc, FTI. It's not just oil and gas explorers and producers among the stocks that have dropped the most in 2020, but companies that provide equipment and services to the energy industry as well, such as UK-based Technipfmc. FTI makes the services the sort of high-tech, capital-intensive machinery that producers use to drill for oil offshore, on land, and in shallow water. It also builds systems for the treatment and transportation of oil and natural gas. Just as investors in companies like Boeing, BA, and Lockheed Martin, LMT, use orders and backlogs to gauge future prospects, FTI investors do too. As of last quarter, those numbers look fairly grisly, with inbound orders falling to 86% year over year from $11.2 billion to $1.53 billion. Number 1. Chesapeake Energy. Finally, we get to the biggest loser, or at least the biggest loser still standing, of the past 11 years. Onshore fracking leader Chesapeake Energy, CHKAQ, 22 cents, has lost an incredible 98.5% of its value, and its shares now trade at just 22 cents. There's no real surprise here. The energy sector is hurting, and leveraged players such as Chesapeake are hurting the worst. Chesapeake's survival as a publicly traded company is in jeopardy. If nothing else, CHKAQ won't meet the requirements to stay listed on the New York Stock Exchange if it doesn't do a reverse stock split. The New York Stock Exchange requires that its listed stocks maintain a share price of at least $1. But the problems go beyond delisting. Chesapeake avoided bankruptcy in 2019 by renegotiating terms with creditors and issued a going concern warning in its third quarter earnings call. A stock as cheap as CHK could be considered a nice lottery ticket. It wouldn't take much in the way of good news to send the shares up hundreds of percent, but like a lottery ticket, you have to be prepared to lose your entire investment. Do let us know in the comments how this pandemic had an impact around you. Please subscribe to the Stock Advisor. Thanks for watching.